Hello everyone. Today we are going to be recording. I'm going to be recording chapter 14. Chapter 14 is long-term liability. In chapter 13 we talked about short-term liability. In chapter 14 we're going to talk about long-term liabilities. Long-term liabilities. So what are long-term liability? Liability, another way of saying it, is an obligation. If obligation is long-term, is longer than 1 year. So obligation or a debt, liability is obligation or a debt that is not payable. I'll just say not payable within 1 year. Or operating cycle of the company. Example of long-term liability that comes into my mind at this point is you have a loan payable, a mortgage payable, you have leases, which we're going to be talking about it in chapter 20. You're going to have a long-term liabilities are your pension, which we're going to be talking about it in chapter 19. Then we have bonds payable. Bonds payable, that's what we are going to be talking about in this chapter. Bonds payable. So when we're talking about bonds payable, there's a different type of bonds. If you go to, there's a full list on list in your chapter 14, page 14.4, there's a list of it. When I think of a bond payable, there's a term bond. There is a income bond. And then there is a, think about it, there is a serial bonds. Serial bonds are issued and mature in installment. When you think of a term bond, they're issued on the single date. That's why it's called a term bond. Then we have callable bonds. Then we have a convertible debt. There's so many of them. There's a coupon bonds. There is a deep discount bonds. So there's so many of them. If you wanted to know all of them, I recommend going to chapter 14, page 14.4 has a list of different type of bonds. Now when we think of a bond can be, now when we think of a bond payable, they could be issued at par, they could be issued at a discount, they can be issued at a premium. So there's a three type that comes in it. So when we say par, what do we mean by par? Par means is if the present value of the bond and the face value of the bond, if they both are same, then it's a par. So this is at par when they both are, whatever the present value of the bond and then what is the face value of the bond, they both are same. They're at par. They're issued at a par. When the present value and the face value, if the present value is lower, it's a discount bond. If the present value is higher, then it's a premium bond. So there is three types that we are going to be talking about it in this chapter and learning about it. You may have learned it in the other chapters in your other accounting courses, but we're going to be learning in details in this chapter. So there, when they say par, you know that they are, your present value is same as your face value. When they say, when the present value is lower than the face value, then it's a discounted bond. If the present value is higher than the face value of the bond, then the bond is issued at a premium. How do we calculate it? We're going to use our BA2 plus calculator to calculate the bonds. Again, if you have issues how to use the calculator, visit the PDF that I posted on BA2 plus on the Blackboard. So just go through that, but we're going through that in this chapter too. So when we now going back to now how do we calculate the bonds? How do we know if it's a premium, discount, or example in an example? So let's go to that leads us to our next example. It's saying bond issued at, now these examples, they are posted in your chapter 14 files. You can download them before you can go through this recording, or you can go through this recording and then download the examples and then redo them so that you can refresh your memory with this chapter. These examples are right from your chapter, except one or two that they're from my old book that I had it. I thought they were good examples. So let's go through. We're going to be going through example 1, which is going to be bond issued at par, discount, or a premium. How do we calculate it and how do we know it? Now when we issue a bond, normally there's two rates are given. One is a stated rate. Let's erase this part a little bit so I have a more room. So let's say, so then now bond issued at par and a discount and a premium. So when we think of that we what I was trying to say is that we have a bond. How can we tell what is a stated rate and what is a coupon rate? Stated rate is stated in the issue. When you issue a bond, rate is stated. That's a stated rate. And then you have a coupon rate, which they both are same thing. Stated rate and the coupon rate is, they both are same thing. So when they're talking about marker rate, is what decide if the bond is at a premium or a discount. So stated rate or a coupon rate is stated in the bond when we issue the bond, and marker rate is what tells you that indicates if the bond is at a premium or a discount. So we're going to go through quite a few examples to figure out how to calculate each one. So then in this case, it's a 3-year bond issued at a face value of 100,000. That should not be a comma, it should be 100,000, and the stated rate of interest is 12%. And now they're saying if yield rate, that's your marker rate. So how do we calculate then in these 3 questions where we need to calculate present value of the bond, and we're going to show you how to calculate the present value of the bond. We know the face value of this bond is 100,000. How long you have this bond for? We had it for 3 years. We have it for 3 years. And then we have a stated rate, which we said that stated rate is same as your coupon rate, and that is used to calculate your payment or your interest payment. So face value of the bond is 100,000. We know the coupon rate is 12%, so our interest is 12,000 a year. Then we have an IY. IY is your marker rate, and that is your marker rate. In this case, it's a 10%. And then we're going to say compute your present value. When you compute your present value, you're going to get a number which is going to be 104,973.70. So the first question is asking if the bond is issued at 10%, what is the present value of the bond? And the present value of the bond is $104,973.70. Now in this case, the second part of the question is what is the present value of the bond if the marker rate is 12%. Now if you look at it, your marker rate and your coupon rate both are same. If they both are same, it will be issued at a par. That means present value of the bond will be 100,000. However, we need to calculate it and see if we are right. So if you were to do this, then let's do a different color for this color ink we could use. So then in this case, we know the face value of the bond is 100,000. N is equal to 3, and your IY, which is your marker rate, in this case the marker rate is 12%, and our payment, which is going to be 100,000 multiplied by the 12%, it is going to give you 12,000. And then you're going to compute your present value. if you compute your present value, it should come up to 100,000. But we didn't need to do this calculation. We could have kind of guessed it, saying, not guessed it, we should have known that if the coupon rate, this is your coupon rate or your stated rate, and this is your market rate. If they both are, sorry, if this is a market rate, if they both are same, the bond will be issued at par. In other words, this is at par. If it's more than the face value, this is a premium bond. Now let's see what happens on our third example. Let's do a different color of a pen so we know for sure what we are doing. Now we're using the same question again, your face value. Sorry, I thought I changed the color, but it did not get changed. So let's do that. So face value of the bond is 100,000. Your N is going to be your 3 years. Your IY is going to be 15%. Our payment will be at 12,000. And we're going to say compute your present value. It should come up with the numbers 93,150. So in other words, the present value of the bond is 93,150. This is a discount rate. Now there's another way of looking at it. When you're comparing your coupon rate and market rate, if coupon rate and market rate are same, let's see if I could put it in here. If you have a coupon rate and a market rate, if coupon rate is 12%, market rate is 12%, bond is issued at a par. If a coupon rate is 12% and your market rate is 10%, it is a premium bond. And if it's 12, this is going to coupon rate is same, and if this is a 15%, market rate is 15, it will be a discounted bond. The reason I'm telling you this, you could have a multiple choice question in your, when you're doing your Wiley Plus quiz or you're doing your final exam. If you're given two rates, can we tell, before, we don't need to calculate it, can we tell if it's a premium bond, discounted bond, or a par value bond? So yes, we can tell, we can compare the both interest rate and we can tell if it's a premium bond or a discount bond. Now we learned there's three types. Bond could be issued at par value, discount, or a premium. So when we learn how to do it, we need to do journal entries. Of course, accounting is all about journal entries. So how do we do journal entries? Now assume that a company plans to issue 10-year bond with a par value of 100,000. Now if you think about a par value, so that's your face value and your par value. Par value is both face value of the bond and the present value of the bonds are same. So we wanted to know how to do journal entries. In this case, that we're learning a little bit something else new we're learning is the bond is this bond is issued at par value, and they have a semi-annual interest rate. So now I will show you how to do it, but we don't need to show you how to do it. Now if the bond is issued at par value, we know that the cash of the bond is 800,000, and then bond payable will be 800,000. But you could calculate it if you want it. How are we going to calculate it? We know face value of the bond is 800,000. In this case, we don't know the market rate, so it's hard to calculate the present value of the bond because you need two interest rates in order to calculate your bond payable. So in other words, we cannot use the formula to calculate it. The question states that it's with a par value of 8,000. So if it's a par, they both are same. They both are present value of the bond and the face value of the bond is 800,000. So the present value of the bond will be 800,000. So they both are same. Now going to your second question, the question is asking record the first semi-annual interest payment. So when is your first installment due? It's due on we got the bond on January 1st. The first installment will be on July 1st. So how do we calculate it? We know the coupon rate is 10%. So 800,000 multiplied by the 10% gives me 80,000. But this is our first semi-annual payment, and in a year there's two payments. So you multiply by 6/12, which should give you 40,000. So how do we record the interest payment? We're making the payment here on July 1st. That's your first semi-annual payment, July 1st. We're going to debit the interest expense of 40,000. We're making the first cash payment. Credit will be a cash of 40,000. Then our next payment is not due till January 1st, but a company has a physical year end, which is December 31st. Even though our payment is due on January 1st, but we have to record at the year end, December 31st, 2020, we have to record an accrued interest expense entry. So how do we record that? Debit the interest expense, credit your interest payable. In this case, the payment is going to be same. It should be 40,000. I don't need to show you how to calculate it because I showed you in the previous journal entry when we did how to calculate the 40,000. Again, it's 800,000 multiply the coupon rate, which gives your yearly interest is 80,000, and we made the first installment payment. Now here is we are making an accrued interest payment. When a January comes, we're not told to do this entry, but when January comes 2021, you're going to debit the interest payable and credit your cash for $40,000. Now we learned this was our first example. Our next example is going to be, now we learned bond can be issued at par, bond can be issued at a discount, and bond can be issued at a premium. If the bond is issued at discount or a premium, this discount or premium is amortized. When it's amortized, there's two way of amortizing a discount and a premium. One is a straight line method. The other one is effective method, effective interest method. Now, if it's if a company is publicly traded, they're going to be using IFRS. They will have to use the effective interest method. But if it's a company is following ASPE, they have a choice. They can use it's recommended. They can use straight line or they can use effective interest method. So either one is acceptable. So it depends on the company what they want to do, and from there you needed to know what method to use. If you are told in the question company is an ASPE company and they don't tell you that they are following they're using effective interest method, then you automatically know that they are using a straight line method. If it's an ASPE company, they told you that they are using an effective method, they have a choice of using that effective interest method. So let's use this next example to calculate to amortize our discount or a premium at a straight line method. So this is the example. We're going to be using a straight line method. So let's see if I could erase what I put it in. So because I need this room. So now if 800,000 of the bond was issued on January 1st, 2020, sometimes you're given interest rate and sometimes you're given at 97%. So sometimes they're given 103, 104 and 105. What does that mean? So then what they're doing is the face value of the bond is 800,000. In this case, we issued it at a 97%. That gives you the present value of the bond. So how do you do it? 800,000 is the face value of the bond multiplied by 97%. That gives you 776,123. So you're not always given two rates, a stated rate and a marker rate. Sometimes you're given a number which is a 97%. So if it's a If it's the par value will be 100%. If it's a discount, will be less than 100%. If it's a premium, it will be more than 100%. In other words, it could be 102%. So depending on how the question is worded, you have to read the question carefully before you attempt that question. So then this bond is for 10 years. It's saying prepare a journal entry to record the issuance of the bond. So we know we issued the bond at 97%. So when you record it, all the bonds are recorded at the present value at the present value. So debit will be the cash, which will be 776. Credit will be your bond payable, which will be 776. And let's raise this so it's 776123. So we know the face value of the bond is 800,000, and then the present value of the bond is 776. So difference between the present value of the bond and the face value of the bond is your you could have a discount or you could have a premium. So in this case we have a discount. How much is our discount? The difference between those two, which is your 24,000. How did I get the 24,000? 800,000 minus the 776 gives me the 24,000. And this question we're going to be learning about a straight line to amortize your discount on a straight line method. So how do we do? We're going to your discount is, how do we amortize it? The discount is 24,000 over the life of your bond. The life of the bond is 10 years. So we will be amortizing $2,400 of this bond every year. And if I were to record an entry, how would I record an entry? So I'm not making an interest payment or anything. I'm just recording an amortization for the discount. So your debit will be your interest expense of 2,400. Credit will be your bond payable of a 2,400. Now by the time the 10 years are gone, the value of, if you are bond payable, we started off with the 776,000. Every year I'm going to be doing the $2,400 entry. Every month we're going to be doing $2,400 every year, sorry, $2,400 entry. So after the 10 years is gone, the value of your bond, the face value of the bond will be 800,000, and when that comes, you debit your bonds payable and credit the cash to pay your bond payable. So this will be your first year, this will be second year, this is third year, this is fourth year. So you're going to have a 10 years. By time 10 years happens, then the value of your bond will be which will be the face value of the bond, which will be 800,000. So that's the one way of amortizing your discount. Let's learn another way of amortizing your discount, which will be your effective interest method. That's the second another way, not the second way, another way of calculating it. And if a company is following IFRS or it's a public company, they will be following effective interest method. And if it's an ASPE, they can choose to follow straight line method or effective interest method. So either way, whatever they decide to do, that is their choice. So let's see if we could calculate the present value of the bond. So in this case, we are given two interest rates. We are given an effective rate and we are given a state issued. When they say issued 100,000 of 8% term bond, that is a coupon rate. 8% is your coupon rate, or your 8% is your coupon rate or your marker rate. So that's what it is. So now let's see if we can calculate the present value. Now you should be pro at this by this time, because we have done a couple bond questions, and I have posted a BA2 plus PDF form document for you on your Blackboard, so that you know how to calculate your how do you know how to use BA2 plus calculate to calculate your present value of your bonds. So let's see if we know the face value of the we know the face value of the bond is 100,000. We know your N. In this case, if you look at the interest is payable on July 1st and January 1st, means in a year there's two payments. And then in this case, the question is telling you that we issued a bond on 2020 and the due date of the bond is 2025. There's 5 years. If there is the interest payment is paid every semi-annually, then whatever is your N multiplied by 2, because you're going to have a 2 payment in a year, your N will be your 10. When you have in your IY is your 10, which is your market rate, divided by 2, which is going to be 5. You can use your calculator. You can convert your calculator into semi-annual rates, or you can just put it in your calculator the way I'm showing you. I prefer to do it this way because some examples are annual rates, some are semi-annual rates, so you don't want to go back and forth and make a mistake with the question. So then keep your calculator at the annual rate and convert your rate and your N manually, and then insert it into your calculator to make your life a little bit easier. Then we have a payment. Your payment is going to be 100,000 multiplied by the coupon rate. We know that there's two payments in a year, times 6 divided by 12, or you can divide it by 2. So that should be your 4,000. So your payment will be 4,000. You're going to compute your present value. In this case, your present value should come to 92,278. So we know that if there's your effective rate, which is your market rate, is different from your coupon rate. So the first part of the question is, what is the calculate the present value of the bond? The present value of the bond is 92,278. Now our next thing is, in the last question we learned how to use a straight line method. Now in this question we're going to be learning how to do an amortization if we are using an effective method. So we know present value of the bond is 92,278, and we know the face value of this bond is 100,000. So carrying amount is the amount we start off with. So on January 1st, that's when we issued the bond. The carrying amount of that bond is 92,278. So we know this bond is a discounted bond because the present value of the bond is lower than the fair value of the bond. And difference between the present value and the face value of the bond is your discount. In this case, it should be your it's going to be 7722, I think, because I put it into 2 decimal places, so you don't have to put it in 2 decimal places, but if the question is asking you to do it in 2 decimal places, you could do it 2 decimal places, but I just rounded up in this question to make it a little bit kind of easy to follow through it. When you have your cash payment does not change. So what is your cash payment? Your cash payment is the payment that we calculated, so which is right here. So in this case, your cash payment does not change, so it's going to be 400,000 every semi-annual payment. And how do we calculate the interest? The interest is calculated. You have a carrying amount, which is, I'm going to do it here. Your carrying amount is 92,278. And what is our market rate? Our market rate is 10%, but this is our first payment, which is semi-annual payment, multiplied by 6 over 12 should give you 4,614. So now some of the when we made the interest payment, some of is cash and some of is my discount that is amortized. So difference between your cash paid and your interest expense is the amortization of your bond, which is going to be 614. And then if it's a discount, you're going to be adding it to your carrying value. That will be 92,892. When you calculate your next one, I'm going to do it here. You have 92,892 multiplied by 10%, about times 6/12 should be your 4645, and then difference between your 4,000 and 4645 will be your bond will be amortized for this payment 645. You're going to add it. You should get a number of 93,537. You can go ahead and finish this table, and you can check this table with your book. It's exactly the same table that is listed in your book on page 1413. So chapter 14, page 13, you can finish the table. So by now, what did we learn? If it's a discount, you're going to be adding it. If this bond was a premium bond, then you will be subtracting it to get your carrying amount. Let's see what the question, then by the time you finish amortizing, the 10 payments are done, this will be your 100,000. It will reach to that 100,000 that we want to reach to in 5 years. So you can go ahead and finish this table, and you can check your solution with the book. It's on page 13 of your chapter 14. So now the same question is we have to journalize it. So the first is the entry to record the issuance of Master Corporation bond on January 1st. We record the issuance of the entry at the present value. So that will be cash. We will have a bond payable, which will be the present value of the bond, 92,278. Now the second part of the entry is to record your first semi-annual payment. This is on July 1st. If we know that in this question we know the cash paid is 4,000, so that's the first thing we're going to do. We know the cash paid is 4,000. Now we know debit will be your interest expense. How much is the interest expense? If you look at this table, in this column, which is 4614, so then you're going to interest will be 4614, and bond payable will be 614. So if you look at it now, this bond every year is going to be amortizing. It's going to go up to 100,000 when we finish amortizing the 5 years. Now the next entry to record the journal entry to record the accrual. If it's accrual, that means we have no cash payment. So what we're going to do is debit the interest expense of 4645, because our payment is due January 1st, 2021. So our payment for I'm going to go up again. Our payment is for the January 1st is 4645. So what we are doing is we're recording in a accrued entry. So you have a bond payable, and in this case we're not making a cash payment, it's an interest payment because it's an accrued interest. The payment isn't due till the beginning of January 1st. So the accrued interest will be your 4,000, and that should be your 645. You could always go back at the top and then look at your discount, what is amortized. So that was the bond was issued at discount at this one. Now when you have a bond, if sometimes what happens in the company can repay their bond earlier. We're allowed to do that if it's in our agreement. So if you do that, how do we journalize? You could have anytime you repayment your note, you could have a gain, or you could have a loss on a redemption or on a repayment of a bond. So let's see how we can calculate it if there is a repayment of the bond. That leads us to our next example. Is saying repayment before the maturity date. It's not that we have to repay on a maturity date. If it's in our agreement, we can repay it earlier. If we have to calculate it earlier, how do we calculate the gain or a loss on a redemption of a bond. So let's do the next question to see if we could figure out how to do that. And this question is saying repayment before the maturity date. So let's read the question. I assume that on January 1st, 2020, what the company did was that they issued a bond, and we wanted to know what happens with that bond. So General Bill Corporation issued a bond with a par value of 800,000, but they didn't issue it at a par, they issued it at a 97%. So that we know that it's less than 100%. If it's less than 100%, it's a discounted bond. It's not a premium bond. So they're saying the bond was due in 20 years, but 8 years after, the company decided that they want to make a repayment at 101 and cancel that bond. So when the word is saying that the entire issue is callable at 101, you don't have to do the entire. You could do 50%, you can do 30%, depending on how much money the company has. They can recall only the part that they want to recall. Now, in this case, the question is giving away there is a loss on redemption, but we needed to figure out how much is the loss. And this could be, this company is a private company because they're using a straight line amortization. So now we know the 8 years has gone by. So before we get to that, we wanted to know what the bond what is the carrying value, and what did we start it off with. There's two ways of doing it. Whatever you find it easier, that's the method you will use, and I will show you both methods. So the first thing we needed to know, what was the present value on January 1st, 2020, and we know the face value of the bond was 800,000. The present value of the bond was 800,000 multiplied by the 97%, which would have been 776. Difference between those two was it's a similar question that we did it earlier, so we have a discount. In this case, the discount was amortized over the life. The life is 20 years, so we're going to amortize 1,200 per year. So we know we had a discount that needed to be amortized, which was 24,000. We know 8 years has gone by. 8 times the 1,200, so 9,600 is amortized. Discount is amortized. So how much is unamortized? And amortized is difference between those two. Should give me a number, which should be 14,400. So now there's two ways of calculating it. So now if we know that when we learn the table, we start with a carrying value, which was 776,000. And then how much of the bond we amortize? We amortize $9,600 worth of the discount is amortized. So this is my amortize. Then gives you a carrying value. The carrying value of our bond will be 785,600. Or there's another way of doing it. We know the face value of the bond is 800,000. That's the face value of the bond. We know the discount. Then what you're gonna do is your discount that we didn't unamortized discount. Here you will use an amortized discount. Here you're gonna use an unamortized. Amortized discount, which will be minus of 14,400, should give us the same number, 785,600. So like I said, that we have two ways of calculating the carrying value. We need to do the carrying value before we can repay this loan, this debt. So then so what happens in this case? We know the bond payable will be 785,600. So now the entire issue is called at 101 and canceled it. So the cash we paid is, so something happened. So So the cash we paid was going to be the the cash we paid. The cash we paid is the 101 multiplied by the your rate, which is going to be 800,000. So something happened to my computer. Let's see what's happening. So let's do this. Go back. Your cash is going to be, oh, it's back now. 800,000 multiplied by 101% gives me 80810. So we paid, our liability was lower and we paid more than what our liability was. So then we have a loss on, it's called loss on redemption of a bond. Which is going to be different between those two, should be your 23,400. No, 22, sorry. 22. I'm not sure. Let's work out the number because I don't have that number. 808,103. It's 22,400. So that number would have been 22,400. So different between the, so if you need a debit entry, it's a loss. If you need a credit entry, it will be a gain. So this is a question if the company is using a straight line amortization and they repay their bond earlier than their due date. So let's go to our next example, which is your in this case you repayment before the maturity, but in this case the company is using an effective interest method instead of a straight line method. So the question could be asked either one. You could have a both. You could have a discounted or a premium discount. I'm going to stop this recording it here, and then I'm going to start with page 8 of my next recording, which will, because I'm not allowed to upload bigger files. So what we did is we covered up to page 7, and then our next example will be covered in my next recording. Then we will go on with our next recording.